Welcome to Funnance, where your money becomes fun. I hold a master's degree in finance and did nothing with it professionally, but I used the concepts I learned to build wealth and economic freedom. I started this channel to help you do the same. Each video is a short explanation of a topic and how you can apply its concepts to your wallet, followed by a case study from my investing experience. I'm not selling you anything, but giving you knowledge. Okay, this episode of Funnance is on fixed income. Fixed income is a big part of finance, and it's one of the first things that I think you should start. I use the word experimenting. People probably don't like me to use that because it's money and it's important, but you're doing a little bit of experimenting. You're saying, oh, okay, I see how this works. And fixed income is just like it sounds. You're putting in an investment and you're getting a fixed amount of money back. Depending on the time of that instrument and a couple other factors, but we'll keep things nice and simple. So what are examples of fixed income? Fixed income are CDs, certificate of deposits, that you get at a bank, bonds, treasury notes, things like that, that advertise a rate, and that rate is not going to change. It's not going to go up or down. Almost like a mortgage when you get a fixed rate, as opposed to an adjustable one that goes up and down with the Fed's decision on rates. So, all right, CD. So, it's not the ones that we grew up on. It's a certificate of deposit. And the big thing to know is that you can't take it back without incurring a fee. So when you deposit it, you're essentially saying to the bank, hey, I don't need this money for 9 months, 12 months, whatever the term of the CD is. So you can go and loan that out. You can use that money for whatever you want. So, and if you need it back, you're going to get a little bit of a fee. So, I mean, it kind of makes sense. I mean, think about if two friends were borrowing money, you come to me and you say, I need $1,000, and I say, okay, here's $1,000. You're going to give me 5% on that, right? But then I come to you and I say, hey, I need that money back, and you're like, whoa, dude, I just put it down on my house, or I just bought a car. I don't have that. So you can see why it can cause a little trouble. Even the big bad banks will cry foul. So that's fixed income. It's pretty simple. It's a nice way of starting to looking to go beyond your savings rate. And you can get CDs or whatever in your retirement account, in just your bank, really anywhere. Okay, so let's look at one of my CDs. I remember, it was about a decade ago when rates were so low, it just almost didn't pay to have a CD. But now they're pretty good, offering 4, 5, 6%. So let's take a look at one of mine here. And again, I just kind of I like to keep this stuff fun. So of course, if you're going to look at this and say, hey, you can get a better rate somewhere else or whatever, all right, sure. Keep this light. This is the way to make it fun. Don't be have something stuck up your. Anyway, so here's a CD for $2,000. The APY, the rate is 5.01%, and the time period is 7 months. So I can't touch it for 7 months. CDs, getting down into the minutia, I believe that you can have it that you get a payment. I'm pretty sure bonds, a lot of bonds have this option too, where you could just get paid at the end, or you can get paid every month. That money can go into your checking account or whatever. So that's one CD of mine. So it's again, just trying to teach the concepts at first. We'll go and we'll buy a treasury bond, right in a few minutes. But where does this animal come from? The fixed income, the CDs and the bonds. Well, like I said, I told you, the banks using that money to essentially make more money with whatever they're doing with. And that's the same thing with bonds, which are government or corporation or they're like, they need the money and they're saying, hey, we're going to offer up these bonds, these IOUs, so that we can take this money and use it for something right now, because of the time value money. We need money, and we need money right now. You have money, you're looking to grow that money. Well, we'll give you a nice return if you give that money to us right now. So what's an example? Let's do municipal, which is government, and then a corporation. Well, it's essentially the same thing. But the big thing, I guess you could say, that's different is the likelihood or the reliability of getting that payment. Because another big thing of finance, a big concept I touched upon a little bit with the time value money episode, is people just don't. Some people, you don't get paid back. Companies go out of business all the time. Whatever it may be, that you're always taking a risk when you're lending that money out. That's why they say the U.S. Treasury bills and notes are the safest thing you can get, because the government is just going to print more money and give it to you. Yeah, it could be less purchasing power, but you're not going to be empty-handed. That's the argument there. So with a municipal bond, I'm in Miami here, so let's say that the city just did this. Well, they put it up for discussion. They wanted to, wow, this is actually really interesting. They wanted to do combat the affordable housing crisis. So they said, all right, we need, I think it was something like $2 billion. You give us $2 billion, we're going to build up these, let's say a new section of town, new section of Miami with this housing, and with that comes roads and schools and police, whatever. So we need $2 billion, and we're going to offer it at, let's just say 5% over 10 years or whatever it is. So you can go and buy that bond, that municipal bond. The good thing with bonds, and we'll talk about all this stuff in detail with each one, is that bonds, I'm pretty sure, are tax-free. So the money you're getting, you're not going to be paying taxes on that, because it's for the good of the government. And then okay, Miami is probably going to pay you back. There's ways of, they have a huge income stream of taxes and whatnot, and Miami's not going anywhere unless global warming takes it over. But let's say corporations, they have their income stream, whatever their product or services is, but maybe that goes away. And let's do Paramount, because I just saw that Paramount was put on notice, risk notice. So if Paramount, which right now they're not making money, on the books, if they say, hey, what was the $2 billion that Miami wanted? Well, Paramount wants $2 billion because they want to build Paramount theme park. Same thing, 5%, but the problem is that they might go out of business and you don't get it. So maybe actually that 5% wouldn't be 5%, it would be much higher, because like we talked about before, the bigger the risk usually would mean a better rate or a better return. That's Paramount. But let's say, a corporation is selling camcorders, or something like that, and they ask for a bond that's a 10-year bond. This is back when camcorders were still around, and now they're not. So now the corporation can't make that payment. So that's one thing that you just have to that's one thing that you factor in with bonds, and we'll go into the ratings and buy a bond at another episode. And all the factors that you should consider when buying one. So that's a very simple generalization of the concept of fixed income, of receiving a set amount that you can depend on, whether that's from a bank or from a corporation or from the government. Bonds and fixed income, I mean, this is a, books have been written about this stuff, and we'll get into how bonds are traded. Everything, are traded. Sometimes you can buy a bond not at face value because rates are changing every day, every second. And, the risk reward analysis of going into it. Again, treasuries are nice and safe, and then you can get into some risky stuff where we'll go into the ratings where we can look at bonds that are or corporations, whatever, that don't have good credit ratings, and so they need to give you a really nice return rate on that loan. Yeah. So that's bonds. I mean, bonds are pretty simple. Bonds can get actually very interesting, and we're keeping this light right now. Of course, there's people who they're bonds tradesmen. They trade bonds all day. It's a whole industry in itself. You have Bill Gross, who I think he's now retired, but he made billions off of it. And bonds are. Let me put this in this is not the bonds section video, but I guess it is now, where they in finance school they would teach personal finance. I believe, again, don't barbecue me, that your age in your estate, and that's what we're trying to do here. We're trying to build our estate and get that economic freedom. That your age should be your percentage of, this is, I guess, really retirement. Your age should be the percentage of what you have in bonds, because bonds are, again, supposed to be conservative, safe-ish, and not going to go crazy high, but it's going to be going higher as opposed to stocks, which can go like this. So if you're 50 years old, 50% is in bonds. And it makes sense, because the older you get, let's say you're 80, and 80% of your retirement, your income and everything is in bonds, because you need to rely on that. You don't have the time to have your portfolio go down and then go back up. The years are running out, unfortunately. But anyway, that's bonds. So we'll go into the crazy stuff at a later video. But let's get into You Did What? Okay, this case study of You Did What is about Oxford Lane Corporation. Their ticker is oxlc. We'll put up the chart here where we can see their numbers, but they're $1 billion company, and no one knows. I didn't know what they were before I started looking into. I was looking in for high dividend stocks, and we'll look at the dividend in a second. So what is it? What do they do? Well, this is from their website. Our current focus is to seek an attractive risk-adjusted total return by investing primarily in debt and equity tranches of CLO vehicles, collateral loan obligations, which are collateralized principally by a diverse portfolio of senior loans, and which generally have little to no exposure to real estate loans, mortgage loans, or pools of consumer-based debt, such as credit card receivables or auto loans. Okay, so they're saying that because they're saying they're trying to limit the risk, or also it's actually about exposure, because they're saying, like, hey, if you want to invest with us, it's not going to be in these areas in case you've invested in those areas, with a different part of your portfolio investment strategy. What they're saying in English is, they buy debt and they're getting a large payment because that debt is risky. It's a high rate of return. Okay. Risk adjust, they're saying things that hey, they're smart. They're gonna make sure, the loans are backed, they're collateralized, they're backed by assets. So if things go wrong, we won't go that wrong, but no one wants things to go wrong. So this is their business model. And then, let's look at that dividend. The dividend is 18, 17, 19%, whatever it is. The first time I saw that, I went, whoa, what is that? Like Roger Rabbit kind of thing. So is it a dividend trap? Is the lesson? Because one, all right, even with reading that, I just still don't really know what it is. You don't know exactly what it is. Yeah, I saw the chart, the numbers, and that dividend, and the point. All right, so what's a dividend trap? A dividend trap is a company that has a high dividend, but they have a high dividend usually for the wrong reason, and that's because they had a normal sized dividend. It all changes depending on what year you're in. But let's say like a normal dividend is 2, 3%, 4%, somewhere around there, and maybe a company has something that's 7, 8, 9%. And the reason why it's that way because their stock price, the dividend yield, their stock price has been falling for bad reasons. So the dividend yield goes up. So a lot of people see that though, and they go, oh, look at that dividend. This is going to be a good investment, not knowing that it's going down and it's probably going to keep on going down. And so then at the end of the day, your investment, you lost money. Sure, you had that dividend, but it kept on going down and down. AT&T is a good example of that. There's a lot of good examples of it. So anyway, is it a dividend trap? Well, I was attracted by the dividend, that's for sure. I look back and I don't consider it that much of a dividend trap because I knew this was it was an investment, but it was also a little bit of a gamble where I saw it was higher stock price before. I bought it in 2016, 2017, around there. It was for, I think, $9. Right now it's at $5. So it's lost essentially half of its value. But the really interesting thing, and I bought it, back then it was paid, it might have been paid quarterly. Yeah, it was paid quarterly, but now it's monthly. At the end of the month, I'll get I'll put up the dividend. I'll get $40 at the end of each month, which is nice. This is actually one of the parts. It's hard to articulate because of making finance fun, because it's great receiving that dividend, and I justify where I say, oh, that $40 went to my cell phone bill or whatever. That's the way I'm mental jujitsu of having fun with it. But I just crunched the numbers on my initial investment, and here I'll show. I think I invested it was for like 4,000 or something like that, and now it's worth 2,000. Yeah, so I lost like half percent. I just crunched the numbers though with the dividend payment on all those months, and yeah, I'm ahead. I'm ahead by, looks like 1,700. And then I guess you look at it that I'm going to hold on to this forever. It very well might go to zero. So there's that. But I don't consider it a dividend trap because of the fact that like I wasn't thinking I was investing in Caterpillar or Walmart or anything like that. I was investing in something that I didn't know that much about. I just saw the numbers and went, okay, all right, let's take a gamble, and I like it. I'm having fun every month, just getting that little income. So the lesson is, one, just realize there's this thing called the dividend trap. It did motivate me with this stock, this purchase. It is something that I don't regret because I definitely learned from it. I'm actually on the green. It could have been a lot worse. It could have gone to zero. It could go to zero next month. But the other big lesson that I just want to teach with this case study is, for the longest time, let's see, if I bought it like $9. It was up 10, 11. Oh boy. And that is one of the best feelings in the world. I'll talk about this at length at another time, but it's that when you buy a stock, the capital, the price appreciation goes up and up and up, and you can still rely on that nice dividend. It's a good feeling, and you feel like a genius. You feel like the smartest person in the room. With Oxford Lane, I thought I was the genius because it was something that no one knows about. You're going to probably look it up now. Maybe you'll take a look. I don't know. But it was one where it had this high dividend of 15-16% at the time. And I bought it at $9 and it went to $10 and $11, which is a lot when when it's just that small of a price per share. But I felt like a genius. And the thing that I want to teach with also that dividend trap is, and I'll say this a bunch, even if you in your heart of hearts think you are the genius, don't think that way, especially with investment strategy and your investments, and that you cannot be wrong. We're all going to be wrong at one point or the other. The important thing is to learn from it, and the important thing is also to just keep yourself in check. So we're gonna increase our net worth. We're gonna have fun with this. Going back to the thesis, and I really think that this can help you, and I think there's going to be other Oxford Lanes out there where you might see that great dividend and think, ooh. But the important thing is, again, stay humble. You're not the smartest person. Do your due diligence. And then the last thing is that I was in a somewhat good point at when I bought this. I didn't know the company, and I didn't know that much about it. And so this is part where it does get into a little bit of I use the word experimenting, gambling, experimenting. You're seeing what's out there. And then the other thing, and this is going to sound nerdy, but start learning about it. That's what I was. Look up their website. Look up what they're doing. I was definitely intrigued. Can I tell you exactly what they do now? No. But again, I was looking at it more of all right, let's test our just with a little purchase here. And just in closing, again, going back to the thesis of having fun with this stuff, and here you can say, oh, look, you lost money. Well, you lost capital appreciation with the stock purchase, but you made it back on the dividends. And so this was a mixed bag, but I had fun. I'm having fun with it. It's nice receiving those dividends at the end of each month. Yeah, it's risky. Yeah, I still can't tell you exactly what the company does, but I'm having fun with it. It's one of those things too that if you probably don't want to hear, losing money is fun. And it's not, but you can learn from it. And this is one of those times where I will definitely be more cynical when I see a stock like this with such a high dividend than I was, 8 years ago or 7 years ago when I bought it. So, all right, let's keep it fun. Let's keep going. And I'll see you in the next video. All right, that's the episode. Please subscribe, like, and comment any questions or topics you'd like me to cover in a future episode. Log on to Funnance.com to learn more, and let's have fun with finance.